To understand why it was a shock last month when Berkshire Hathaway invested $6.5 billion in 5 Japanese trading houses that have been around for far longer even than its 90-year-old chairman, go back to a talk Warren Buffett gave to business students in Florida in 1998. As a sprightly sexagenarian with his sleeves rolled up, the sage of Omaha was at his witty and wicked best. The first question he fielded was about investing in Japan. He replied that the country's 1% interest rates made it look attractive. Nonetheless, he considered Japanese firms poor bets because of their lousy returns. Low-profit businesses could be worth buying based on what he called the cigar butt approach. You walk down the street and you look around for a cigar butt someplace. Finally you see one and it is soggy and kind of repulsive, but there is one puff left in it. So you pick it up and the puff is free. But not even this theory would draw him to Japan Inc., the pride of the country's post-war revival, he explained. It is hard to think of an analogy more distasteful in a spick-and-span country like Japan. Some 22 years of rock-bottom interest rates later, Mr. Buffett has finally overcome his stogie-phobia. Berkshire's investment in 5% each of Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo, though small relative to his investment firm's $140 billion mound of cash, was its biggest outside America. It said its stakes could increase to as much as 9.9% over time. But the acquisitions were a head-scratcher. What, if anything, had changed over the past few decades to make the trading houses appealing all of a sudden? Or had Mr. Buffett simply succumbed to the temptation of a few cheap puffs because money was burning a hole in his pocket? At first glance, the acquisitions make it look like he has lost the plot. The trading houses, or Sogo Shosha, make a mockery of many of the investment principles he has stuck to all his life. He says he likes easy-to-understand businesses like Coca-Cola and Apple. He argues that companies should not just be cheap, but have reliable returns and, ideally, moats to keep competitors at a safe distance. On each count the trading houses fail dismally. Start with simplicity. In Westernized, no Japanese company is a model of Anglo-American shareholder capitalism. But few seem as far removed from it as the trading houses. They are shaped by history, which dates back to the 19th century Zaibatsu and post-war Keiretsu. System of corporate loyalties and cross-shareholdings. In the modern era their business models have twisted and turned. From the 1950s to the 1980s they acted as go-betweens, scouring the world for energy, metals and minerals, helping to underpin Japan's economic miracle. Then they invested in mines and hydrocarbons to feed the China-led commodities boom before shifting downstream, buying everything from convenience stores to cable companies. In the process they accumulated assets faster than they sold them. The results are unwieldy. Mitsubishi peddles everything from coking coal to Kentucky Fried Chicken. Itochu, the most profitable, calls its consumer division the eighth company, implying it has run out of names after 7 other units. What about returns and value? Undoubtedly, the trading companies are cheap. Of the 5, only Itochu trades at a market price higher than the book value of the net assets on its balance sheet. That is not to say they are a bargain though. Kikuwa Tatsuya of JP Morgan Chase, a bank, says their low-return legacy assets, which sometimes suffer big write-downs, increase investors' perception of risk. Their complexity raises their cost of equity, which is higher than for more focused commodities producers, such as ExxonMobil or Rio Tinto.